In 48 hours, the market delivered a move that was supposed to be impossible in a system that calls itself deep and liquid. Gold, the asset people treat like the slow heartbeat of global fear, swung roughly $1,200 from the prior week's peak to an intraday low near 4,402 on February 2nd, 2026. That is about a 21% drop in a handful of sessions, the kind of air pocket move traders usually associate with forced selling, not orderly price discovery. Silver, which tends to magnify gold's stress when leverage is involved, slid into the low 71s in the same unwind. Not months, not weeks. In a blink of macro time. They said this couldn't happen. Not like this. Not with well-telegraphed policy, not with risk controls. But the tape did it anyway, and when the tape breaks expectations, it is rarely random. It is leverage being unwound. It is crowded positioning getting hit. It is risk limits and margin rules forcing a sequence of selling that looks irrational until you realize the market is not arguing about value in that moment. It is arguing about survival. Because here's the uncomfortable truth. By the time most people read the explanation has already been traded. When gold reacts at the open, when FX gaps on a headline, when the Treasury curve steepens while a so-called safe haven collapses, the market is telling you that the decision was made somewhere else first. On balance sheets, in futures positioning, in volatility books, in the quiet math of funding and collateral, and what I'm about to lay out changes how this episode looks, not as disconnected shocks, but as one mechanism running across three markets at once. One variable shifts, three asset classes reprice. The fourth, which is liquidity itself, decides who gets to stay in the trade. Welcome to Signal and Shift, where we decode what matters before it becomes dinner table conversation. The goal here is simple. Take the numbers, the timing, and the cross-market contradictions, and translate them into a map you can follow. If you've been watching markets and feeling like the story is always one step behind the move, you're in the right place. And as we go, drop a comment with where you're watching from, because in a fast market, the most useful thing is knowing how many people are seeing the same stress signal at the same time. Now let's reconstruct what actually happened, with a kind of forensic detail that exposes the real driver. February 2nd, 2026 wasn't just another Monday. The open hit like a switch. Only days earlier, gold had printed highs near 5,602. That level matters not because it's round, but because it attracts momentum funds, systematic trend followers, and option structures that assume breakouts continue. Then the trade flipped. Gold slid, then it fell, then it cascaded. By the time the dust settled, prints clustered near 4,402 intraday. The path down looked like the market was stepping on trapdoors, one support level, then the next, as stops fired and liquidity thinned. At the same moment, the foreign exchange market reacted as if someone had rewritten the path of U.S. policy. 5% in response. That detail matters because FX isn't reacting to personality, it's reacting to perceived reaction function. Markets don't trade people. They trade what people are expected to do under pressure. Then you look to Treasuries, expecting the old script. Fear rises, yields fall, and duration rallies cleanly. But the curve was already telling a more complicated story. 45%, 728 percentage points, one of the steepest readings since early 2022. That is not the signature of a simple narrative. It is the signature of competing pressures being priced at the same time. The front end anchored to policy expectations, and the long end demanding compensation for time, supply, and uncertainty. So in one compressed window you had the triad. Metals collapsing, the dollar spiking, and the curve steepening. That combination is the central mystery. If the move was pure risk-off, why would gold collapse at the open? If the move was pure rates up, why would the long end not explode higher immediately? And if the move was pure inflation fear, why would the inflation hedge be the one getting punched? This is the part no one is discussing. You can't understand the event by looking at any single chart. You have to read the tension between them. That tension is the signal. When markets behave like this, there is usually a historical rhyme. Not because history repeats neatly, but because the plumbing of finance hasn't changed as much as the narratives claim. Leverage still exists, margin still exists, funding still matters. And when funding conditions shift quickly, the same assets get sold first for the same reason. They're liquid, they're profitable, and they can be sold without admitting the deeper problem. Start with 1980. Gold had surged through the 1970s as inflation and credibility collapsed. Then policy turned. Real rates rose. The market decided the central bank would protect the currency even if it hurt everything else. The trade that felt unstoppable reversed, and the reversal wasn't gentle. It was a long repricing where the metal that had felt like certainty suddenly felt like regret. The lesson is uncomfortable. When the market decides policy will be tighter than expected, crowded inflation hedges can fall first, even if long-term fears remain. then 2008. In the early phase of stress, you might expect gold to rally immediately, but during the acute liquidation window, gold sold off too. Why? Because in a margin event, the best collateral gets sold to meet calls. The asset that is easiest to sell becomes the asset that is sold, regardless of its narrative. The result was that gold eventually recovered and rallied later, but only after the forced selling phase exhausted itself. First the liquidation, then the narrative, then 2020. In the initial shock, there was a global scramble for dollars. Funding markets tightened. Even safe assets got sold to raise cash. Gold dipped with everything else during the first punch, then later ripped higher as policy response expanded balance sheets and compressed real yields. Again, the first move was about liquidity, not ideology. The second move was about reaction function, not fear. There is another rhyme that sits in the middle, and it matters, because it was also triggered by a sudden shift in rate expectations, 2013. When the taper conversation hit that spring, the market repriced the path of accommodation. Real yields climbed and the dollar firmed. Gold suffered one of its sharpest modern drawdowns, dropping by roughly the high 20s in percentage terms over the year, with the most memorable air pocket arriving in April when liquidity disappeared for hours at a time and price seemed to fall through levels that had looked solid the week before. The lesson was not that gold stopped working. The lesson was that gold is exquisitely sensitive to the marginal buyer's funding cost. When real yields rise, the opportunity cost of holding a non-yielding asset rises. When the dollar rises, the global price of dollar-denominated commodities tightens. And when both rise together, the trade can unwind violently, especially if it is crowded. That episode also revealed the same psychological trap you see in 2026. Traders confuse the reason they bought an asset with the reason they are forced to sell it. They buy gold for long-term currency protection. Then they sell it because a margin call doesn't accept philosophy as payment. In 2013, as in 2008 and 2020, the initial liquidation phase was about raising cash and cutting exposure, not about a committee deciding what gold should be worth. Only after forced flows cleared did the market regain the ability to trade on slower fundamentals again. So when you watch 2026 unfold, keep that 2013 lesson in your pocket. The catalyst can be different, but the mechanism is the same. Shifting rate expectations, changes, funding costs, change positioning, and positioning changes price first. It is the same playbook in different clothing. A narrative shock hits, models reprice, margins adjust, and the most liquid winners of the prior run become the first source of cash when the system tightens. That is why open can feel like a trap door. Now in 2026, the same pattern is surfacing with a modern twist: speed. Risk systems are faster. Cross-asset portfolios are more integrated. A shock in the rate path can transmit into FX and commodities in minutes. And because positioning often looks similar across institutions, the unwind looks coordinated even when it isn't. It is synchronized behavior driven by shared constraints. So who are the players that make this happen? Not villains, not masterminds, just institutions doing what their mandates force them to do. First, the rate complex. When the market senses a shift in the Fed path, the front end is the battlefield. 2-year yields, short-dated swaps, and policy futures that embed expectations. A move there doesn't stay contained. It bleeds into the dollar through carry, through relative rate advantage, and through global capital that hunts yield with rules, not feelings. A stronger dollar then pressures dollar-priced commodities mechanically. But textbook linkage alone doesn't create a 21% swing in gold in a few sessions. To get that kind of move, you need leverage and you need forced behavior. That leverage sits in futures positioning and in option structures. Trend following funds buy strength and sell weakness. After a run to highs near 5,602, many of those systems are long by design. Volatility sellers collect premium when markets are calm, and they are effectively short volatility until the market moves. Relative value funds run cross-asset spreads: long gold, short dollars, long commodities, short duration, or baskets built to hedge macro scenarios. All of those structures work until a single variable flips and correlations shift. Then come the institutions most people never think about when they hear market. Dealers who warehouse risk, clearinghouses that set margin, exchanges that can change the cost of holding positions overnight, prime brokers that tighten financing when volatility rises. When volatility spikes, margin requirements rise. When margin rises, forced sellers appear. And when forced sellers appear, the market is not choosing a price. The market is clearing positions. Here's where it gets interesting. The timing suggests coordination through shared constraints, not secret meetings. FX jumps on a headline. Gold drops at the open. Treasuries send a curve signal. That is multiple desks reacting to one input, a repricing of policy path and the cost of capital. And that curve detail matters. 45 is not a deeply inverted curve screaming recession tomorrow. It's a curve that has flipped into a steepening posture, and a steepening curve can mean the long end is demanding extra compensation. That extra compensation can come from expected inflation, expected growth, or term premium driven by issuance and uncertainty. In a world of heavy Treasury issuance and persistent deficit debates, the long end can resist. Rallies even when risk sentiment softens. That is how you get the split personality. The front end reacts to policy talk, the long end reacts to supply and confidence, and the dollar transmits the policy shock globally. Now let's talk about the dislocation, because this is the heartbeat of the entire episode. Two markets were telling opposite stories at the same time. Market one is the dollar and the front end. 5% tied to perceived Fed trajectory is a loud statement. It says global capital is leaning toward dollars because the expected return on dollars just rose, or the perceived safety of dollars just increased, or both. Higher front-end yields reinforce that. This combination usually pressures commodities in the short term because commodities are priced in dollars and because holding a non-yielding asset becomes more expensive when cash yields more. Market two is the safe haven narrative. In a pure fear episode, gold should catch a bid as people search for protection from currency risk and systemic stress. But gold didn't catch a bid, it broke. That contradiction is the dislocation, safe haven story versus liquidity reality. When that gap opens, it cannot persist indefinitely. Either the fear story is wrong and the gold sell-off is signaling that real rates and dollar strength will dominate, or the liquidity story is temporary and the fear bid will return once forced selling ends. The market doesn't allow contradictions to sit forever. It resolves them by moving prices until one story breaks. So what's the evidence this was forced resolution rather than a calm reassessment? First, magnitude and speed. A move from roughly 5,602 to about 4,402 in a few sessions is not the behavior of slow allocators. Pension funds do not move that way. Sovereign wealth does not move that way. Central banks do not turn a portfolio in 48 hours. That footprint is leveraged players being unwound. Second, synchronization across assets. 45. That points to a funding impulse. Higher expected rates strengthen the dollar and raise the carrying cost of non-yielding assets. If you're long gold on leverage and the dollar rips, your risk model is screaming at you from two directions: price down and funding cost up. Third, the curve message itself. 728 percentage points means the long end is not simply following the short end lower. It is asserting independence. That makes hedges less reliable. If long duration does not rally cleanly and gold is being liquidated, the traditional protection basket can fail at the exact moment it is expected to work. When a hedge fails, risk systems reduce exposure elsewhere because the model no longer trusts the offset. That is how selling propagates. Fourth, narrative sensitivity. Markets do not move that hard on a name unless the name is a proxy for regime. A sharp dollar reaction implies traders were not waiting for confirmation. They were repricing immediately, and repricing immediately is what happens when positioning is already on a knife edge. One more, TEL sits in the rate data itself. 16, the market was paying up for time. That extra term premium is a quiet tax on every leveraged trade because it tightens financial conditions without a single policy vote. When that tax rises quickly, cross-asset funds reduce gross exposure. They sell what is liquid first. In early February, precious metals were liquid, profitable, and crowded, so they became the ATM. And once the ATM starts dispensing, the line forms fast everywhere. Now let's make the mechanism simple without turning it into a cartoon. Imagine the market like a city built on bridges. One bridge is rates, one bridge is FX, one bridge is commodities. Most days, traffic flows across all of them without stress. Then one bridge gets blocked, expected policy tightness shifts, traffic reroutes instantly. That rerouting increases stress on the other bridges. FX responds first because it is the fastest. Rates respond because they are the source of the shift. Commodities respond because they are priced in dollars and often held with leverage. If the rerouting creates congestion, meaning volatility rises, then the city imposes tolls. Those tolls are margin requirements, haircuts, and tighter financing. The tolls don't care about narratives, they care about risk. When the tolls rise, some drivers can't pay. They have to turn around. That turning around is forced selling. So the chain looks like this. Headline shifts, expected policy path. The front end reprices, the dollar strengthens. Commodity prices feel mechanical pressure. Volatility rises. Margin and haircuts climb. Leveraged longs are forced to sell. And the sell-off feeds back into volatility, which justifies even more risk reduction. That is a self-reinforcing loop. Inside that loop, gold's identity changes. It stops being the hedge and becomes the source of liquidity. If a portfolio needs cash quickly to meet calls, it sells what it can sell, not what it wants to sell. Gold is liquid. Gold futures are deep. Gold can be monetized in seconds. That is why gold can fall even when fear is rising. And silver, being smaller and more volatile, becomes the amplifier. When gold gets hit, Silver often gets hit harder because the same funds that express bullish precious metal exposure often use silver to add beta. When the exposure must be reduced, silver absorbs disproportionate pressure. That's how you can see silver down to the low 71s, while the narrative tries to treat every downtick as a verdict on the future. Now, if this was a margin and funding episode, what does it mean going forward? Historically, when you see liquidation that hits even the safe assets, the next phase is defined by whether funding stress resolves or deepens. If funding stress eases, the assets sold for liquidity often rebound sharply because the selling was not about long-term conviction. It was about meeting constraints. If funding stress tightens further, liquidation can spread from crowded trades into broader markets because the first wave of selling becomes the seed of the second. There are 3 broad scenarios this pattern allows, and the data will tell you which one is forming. Scenario 1 is conservative, a positioning flush. The dollar spike cools as the headline shock fades. Volatility stabilizes, margin pressure eases. In that case, gold can stabilize and recover part of the drop, not because the world is suddenly safe, but because the forced sellers are gone and the market can breathe again. Scenario 2 is moderate, a regime repricing. The market continues to price higher for longer. The dollar remains firm, and real yields stay elevated. In that case, gold can remain volatile and range-bound, with rallies meeting supply as portfolios rebalance around the new cost of capital. The metal doesn't vanish. It simply trades differently under different rates. Scenario 3 is aggressive, the opening act of a broader funding squeeze. Curve steepening continues because the long end demands more compensation. The dollar stays strong. Because global liquidity tightens and risk assets begin to feel the same pressure, gold felt first. In that scenario, the next headlines will not be about metals. They will be about credit spreads, refinancing windows, and stress in places that don't become mainstream until they are already a problem. So what should be watched? Not predictions, indicators. Watch the curve shape, especially whether steepening is driven by the long end rising or the front end falling. Those are different messages. A long end rise is a term premium story. A front end fall is a policy easing story. Watch whether the dollar holds its gains after the initial jump, because sustained dollar strength is a sign of persistent tightness. Watch volatility across asset classes, because persistent volatility keeps margin pressure alive. And watch correlation. If gold starts moving with risk assets again, that suggests liquidity is still the dominant force. If gold starts moving opposite risk again, that suggests the forced selling phase is fading and the hedge function is returning. Now, here's the divide that matters. It isn't about being smarter. It's about paying attention to the right signals. Most people will see gold collapse and assume the story is simple. Gold is broken. Gold was a bubble. The hedge failed. Most people will see the dollar jump and assume it's just a headline pop that will fade. Most people will look at Treasuries and assume they are still the anchor that makes everything else make sense. But the people operating closest to the plumbing read something else: cross-market stress, forced selling. A curve that is pricing more than policy, including supply and confidence. That is why information gaps become wealth gaps. Institutions move first because their systems force them to. They don't have the luxury of waiting for a perfect narrative. Retail moves last because explanations arrive after the move. That's not judgment, it's structure. The market is a machine that rewards early recognition of stress signals. 45, the machine is telling you something about funding, positioning, and the cost of capital. And if you can read that, you are not predicting. You are observing mechanics that have repeated for decades, just at higher speed. This is signal and shift, where we decode what matters before its headlines. If this connected dots you hadn't lined up yet, you know what to do. Because the question isn't whether markets keep reacting to cross-asset stress. The question is whether the next time the open hits, you recognize the pattern before the explanation catches up.